This is for income, personal income tax. I think nothing much has changed in terms of overall rates. All they have done is given some amount of tax credit of 2,000 rupees for people who are earning total income up to 5 lakhs. They're given some benefit for the first time home buyer. He can get an additional deduction on interest by about 1 lakh over and above the existing 1.5 lakh for a home bought in 2014. And he's also given the benefit of spillover effects. So supposing you are got a 50,000 rupees shortfall in terms of claiming this amount, you can spill it over to next year and you can get this benefit. The Rajiv Gandhi Equity Savings Scheme has to some extent been extended, but applicable only to income categories of 12 lakhs. He's increased it from 10 lakhs. And he's hoping that he'll get new investors into the equity market by virtue of this proposal. It's for this scheme is now for each of the next 3 years, and the investments are locked in for a period of 3 years. Overall, there's been an increase in surcharge, like I mentioned. Corporate surcharge rates are up from 5% to 10%. Education cess remains the same, and MAT continues to remain the same. So if you look at the increase in for a person, say, who's earning more than 1 crore, he not only has an increased surcharge from 0% to 10%, he's also paying the education cess charge. So it's a big increase for people who are basically earning more than 1 crore. The overall tax liability goes up by almost 3% because of this proposal. As far as the financial sector, you know that our public sector banks are clearly having an issue in terms of their capital adequacy ratio. Every time they need to be funded by the government. So the government has basically planned to put another 14,000 crores into the public sector banks, which is part of the budget. There is some benefit for small-term home buyers, which I mentioned. Now comes, then there's a double taxation issue on security transactions. Earlier, when you created a securitization, this is all to do with securitization market. There was a lot of ambiguity as to, how the securitization entity would get, taxed. They clarified in the budget that the income for the securitization trust is basically exempt from tax. And whenever they distribute that income, it will be taxed, and the income in the hands of the beneficiary would not be taxed. So that's very clearly, so they clarified this issue. So you'll see a lot of the, pass-through securities, which are one of the things that the mutual funds had stopped doing, will start coming back into the Indian market. Interest rate subvention extended to private sector banks. This was only allowed for public sector banks, which means that if there's a farmer who has taken a loan, he has paid back the loan in time, then he gets a lower interest rate. This is only applicable to the public sector. Now they have given it to the private sector. This is a clarification which has been sought, in terms of write-off of your bad loans. There was a case which was seen where they classified loans into 2 categories: rural loans and urban loans. And on rural loans, whatever provisions were made, you are getting a tax benefit. And there was the write-off subsequently. These write-offs were first set off against the provisions, and any excess write-offs were given the tax benefits. But in the case of urban loan, there were companies who were not following this process. They were claiming 2 deductions. One's on provisioning, and the second is on write-offs. So now they are clarified, saying even for urban loans, you will be basically first have to set it off against your provisions, and after that, if there's an excess, you will get the tax benefit only on the excess and not on the overall write-off, because otherwise it amounts to double taxation. So we are not aware of which banks have been following, but some of the public sector banks have a very low taxation rate. So there could be a case where they have been following this policy. And they are now allowing banks to act as insurance agents. We have to see whether this really works, because banks come under RBI and insurance comes under IRDA. So there's some kind of regulatory issues to get this finally approved, but that is the intent of the Finance Ministry. And they have now introduced a commodity transaction tax on non-agriculture products. Now comes to the big proposal which spooked markets yesterday, which is the tax residency certificates. And I think yesterday was a combination of 2-3 events. One, it was the expiry. Second is you did see some kind of margin selling being invoked, as a result of which you saw some fall in markets. But as far as the budget is concerned, the key issue in the budget was this tax residency certificate. I just want to spend some time in explaining it because all the TV channels today were only featuring the finance minister and number of commentators on this tax residency certificate. Now, what this states is that, and I'll give you how FIs basically invest in India. Normally, you always come through a tax haven, whether it's Mauritius, whether it's Cyprus, whether it's Cayman Islands. Investments get rooted, and right since 2000, it was clearly understood that those coming via the Mauritius route, if they have a tax residency certificate, they would be availing of the benefits of the double taxation treaty between India and Mauritius. Very clearly, mentioned in the Mauritius treaty between India and Mauritius. Now in this budget, the finance minister has put a proposal that tax residency is a necessary but not a sufficient, is not sufficient for claiming the benefits under the Mauritius treaty. So that, spooked the markets because 80% of the money that comes into India comes via Mauritius. And therefore, most of them thought that now the income tax officials will come and say, listen, you got a tax residency, but that's not sufficient. So I want to see whether you're the beneficial owner. Now, the issue was, in the case of Mauritius specifically, the double taxation treaty only talks about tax residency as a sufficient condition. But in a number of other countries where we have these agreements, the beneficial ownership is the criteria for giving you the tax benefit. And therefore, in this budget, the finance minister intent was to make sure that we will look at the beneficial ownership and not the tax residency for you to get the benefits under the double taxation treaty. He also wanted to keep the window open to make sure that if there's any money laundering that really happens, he can go behind the veil of tax residency and find who's the beneficial owner behind it. So that was the intent of this proposal. But what it created was a complete, uncertainty in the market. Because even the genuine FIs got, really worried. Our view very clearly, and based on what the finance minister seems to be saying, because he's saying he's going to revert this entire, proposal, is that for Mauritius, because the treaty is clearly signed and only tax residency is the sufficient condition, it will remain intact. For all other countries where beneficial ownership is required, it will be going by beneficial ownership. I was told in Cyprus, on interest income, beneficial ownership is the criteria. So if it is signed with beneficial ownership is the criteria. But they would like to have that window that in case they suspect that anybody coming via Mauritius is involved in money laundering, they should be able to say that tax residency certificate is not sufficient and go and once again investigate him. So this will be done on a case-to-case basis based on the suspicion they have on the quality of flows that are coming into the country. So my sense is that the genuine foreign institutional investors should not get worried on this new proposal. There will be clarifications, and that is the intent that the finance minister seems to be, propagating in the press post his budget speech. So, though the clarification, there's a notification which has actually come in today, and it has exactly mentioned what I spoke about, but still, perhaps the market has to absorb it. And my sense is that this issue will no longer be an issue, because I think the first thing that when you heard of this proposal, you said last year was GAR, and you saw the markets having a problem with GAR. And then the finance minister goes around talking to all investors across the globe on roadshows, saying that GAR will be postponed and don't worry, and we want foreign money. And then you have this proposal and you have another GAR in disguise. So, but I think that was not the intent of the finance minister. He clearly wants this money to come in. He understands the issue that we have on our current account. He wants the capital account to grow. So he will clarify this, and I think it will be less of an issue in the days ahead. Security transaction tax has been clearly reduced, and also on equity futures as well as in terms of redemptions of mutual funds and ETFs. There's a surcharge on dividend distribution tax from 5% to 10%, and dividend distribution tax are now being imposed on debt funds other than liquid funds. Earlier, the dividend distribution tax on debt funds was about 12.5%. Now they're taking it up to 25% plus the surcharge and cess. So to that extent, if you're investing, say, in the bond market instead of liquid funds, then this new tax will be applicable to that. Eligible securities, this is, there are a list of securities which pension funds and provident funds could invest in. They have expanded that list. FIs can now participate in currency derivatives to the extent they have foreign currency exposures in India. And you have inflation-linked instruments which are now being introduced. This is being done to wean people away from gold. Why are people investing in gold? Because they want to beat inflation. So they're trying to introduce, this instrument to wean people away from gold. And they're now coming with uniform know your customer norms for foreign institutional investors. Today, if you're a sovereign wealth fund or a pension fund or a university endowment fund, there are various rules and regulations regarding what is the KYC. So they are creating uniform norms for that. And this is a very interesting proposal. Today, if you were to invest in the US, you don't have to go to the Security Exchange Commission and get your your registration, and then only you can invest in the US. What you do is go to a broker. The broker does all your KYC, and you start investing. So this is the first attempt where they're asking depository participants, which are authorized by SEBI, to actually now register different classes of portfolio investors subject to the KYC requirements. This was a proposal I was involved with in discussing, with the National Stock Exchange at some point in time as to, how can we get more investors into India? And they wanted to actually have brokers to actually do this KYC. But the issue they had was brokers were not well capitalized. There were a number of small brokers, and this KYC also would not be properly administered. So now they have decided that this will be done by the depository participants. So if any problem happens in the KYC or the person coming in, SEBI has control over the depository participant and will take, action against the depository participant. So this is a good measure.